Hello, Warriors. How's everyone doing? AJ, Bran, Richard, how are you? Welcome to F.A.C.E, and here's mine, Michael Weissman. Everyone doing okay? All right, I would also like to welcome our new viewers at TradingView. Welcome to F.A.C.E. It's an acronym for ForexAnalytix Community Experience. How you doing, team? Everyone doing all right today? Would normally be a turnaround Tuesday. That's not the case. I wanted to start off here with the S&Ps. That yesterday's action makes it look like the failing rally we talked about that was a possibility, beginning to look like more of a probability. That risk off is part of what's going on here. Seen enough of my mug. So we'll see what kind of follow through we get today. Taking out this 4,500 level was important. And I also just want to update you on my Amazon potential short failing rally in Amazon as well. And I did take some new short positions in the regionals after that huge rally that we had in the S&Ps. Pretty weak rally in the regional banks. We're going to have Joseph Wang here today, Fed Guy 12, and his recent article that we'll get to discuss is dollar deleveraging. And he's saying that the foreign banks are actually under more duress than the regionals. So it's going to be interesting to speak to someone who worked at a Fed desk for several years and get his insight. We'll even ask him what he thinks Powell is going to do later on this month. So let me start off with Ryan. Are you here, brother?
Yeah, hey, mate.
Hey, how you doing? So a little bit in euro, not much in cable. Do you have a feel for this euro pound trade? I mean, this was a turn last week. We're still trying to put in a higher low. What's your view here?
Yeah, that 85.20s is a bit of an old on-off level. Goes back the last few months. So, it's, like I was saying yesterday, with all the moves we were seeing, all the big moves we were seeing, when pairs come up against levels, old worn levels, you got to see where they break or not. And this one didn't. But if you just come out a little bit further, maybe on a 4-hourly or something, you can see we obviously had the big move down. And now we're just still in a bit of a downtrend. You know, we're holding that 85, but we just keep and it goes back to the high below prior to that. We're getting over the course of a few weeks, these highs not getting quite as high, and the lows coming a little bit lower.
I like the higher low. You know, you have a frame of reference if you want to pick a spot to get long. At least you know where, a prior low was to have as a stop loss point to manage risk. Where you didn't have it here when we were talking on this tail here, Ryan, last week, you didn't have a frame of reference. You didn't have a higher low potential one anyway. So this was a tougher trade than this one if you're bullish, right?
I still took it because it was a second test of the 85 handle. And you got to remember what drove the break. The break came when German PMI collapsed, and then it flipped the other way when UK PMI collapsed. So it was that candle, that wick is a data move. So when you draw that into the fundamentals, no surprise to see we're still in the range above 85. And same for the euro dollar. We had, everyone was thinking, we could get 105 tomorrow. Well, we couldn't get through 107. So today it's looking like yesterday's moves might have been just a bit of coming back from holiday, end of summer, repositioning, putting new stuff on or whatever.
No follow through.
No follow through today. But look at that move. The bounce has been pretty weak.
It has 107. Yeah, I mean, I've been talking 108 in the Dixie for I don't know, a month now, And, you know, I keep looking for reasons to maybe take a counter trend trade. I don't see it here in the dollar. I still don't even see it in the yen. The yen is closer to diverging. A view on why yen is US dollar yen is lower today. Just kind of like the same type of thing you described with euro, that the strength that
No,
we had.
this
Go ahead.
one's had a bit of action because we've had a step up in jawboning from Japan. The
Okay.
FX diplomat Kanda, you know, one of the top guys, he's pretty much jumped from, you know, we are watching carefully to we are seeing speculative moves, and that's he's taken 2 steps up rather than the usual 1 step up and then another step up. So that gave the market the knockdown to 147 overnight.
Okay.
Matsumo, the chief cabinet secretary, he didn't go as strong, but he kept, we are, you know, watching with a sense of urgency, not reflecting fundamentals. Yeah. But the market's now probably thinking, oh, hello, we might be a bit closer to intervention than we were yesterday, just because it has been a bit of a step up more than usual in the jawboning.
Okay, because we're only, you know, yesterday, one point, only 400 handles away from the intervention levels that we had last year. When you compare the dollar to it, it's been a pretty weak bounce. You know, it's been all yen, but the dollar's having a little trouble here at this weekly moving average, but I still don't see a reason to sell it. In fact, I think that the Dixie would have to take out the 103 level, that level that it held last week, to, you know, say that the trend is changing. You have a lot of moving averages here. So, you know, it could be vulnerable. I'll tell you something that has had follow through as well has been silver. Okay, so we talked about this last week. I know that it was, you know, my tinfoil hat trade with the supermoon, but we've had a pretty nice break from recent highs. And I know that our viewers are prepared for, if it happens, that we're looking for this harmonic to be fulfilled, and comes in around where I have this speed line down at about 2040 is where I'd be looking to start buying silver. So we're not quite.
What about extending that trend line, that uptrend line you've got going as well?
Extending it further
You've got
out
an
this.
uptrend. No, that down below.
Oh yeah. You know, that's true. So people, I forgot about that. That's right around the old lows, around 22.
Yeah, a bit of
So
confluence.
yeah, so maybe we do hold those lows, but there's your triangle. See, this is what I would think would get a lot of people bearish down here, and then you have a completion of a harmonic when all the longs are gone. Because you know how long they've been pounding the drum for the silver squeeze.
Yeah.
You know, I think after this last washout here in silver, and gold's acting much tougher. It's holding this moving average 200-day right here at 1920. But we start getting through 1920, I still think low 1800s, high 1700s is possible. Which, if that's the case, that means a dollar rally most likely isn't over. I mean, gold can rally with a strong dollar. I've seen that happen. But silver definitely only thrives. I've only seen it thrive during a bear market in the dollar. So that's what silver needs, is this dollar rally to complete and reverse. So let me move to Kman. Any feel on what's happening here in China? Any noise from them like Japan? Good morning, Kman. Because you know.
So yeah, there as well. We had a bit of China sending out its submarines when we traded over 732. You know, they've been selling a bit of dollar China apparently, and I've been talking about that already a couple of times. Is that I've got this feeling that when we get close to the 2%. Above where they fix the dollar CNY, even in dollar CNH, they tend to intervene, and we've seen it again overnight. So we have to keep that in mind. but yeah, I mean, for the rest, if you look at it, we're holding that around that 730, and the market is sort of, I'd say, in a bit of a wait and see mode. But I'm going to call it pretty high levels. I know other people have different views, but to me, that doesn't seem like a currency that wants to start to reverse yet.
Yeah, it looks incomplete to me, Kay. Here's drive 1, here's drive 2. Looks like it needs a move over 735.
Yeah.
So
Yeah, there's something telling me that it might not completely be done. Okay, you've got the dollar side as well, right?
yeah,
And on the dollar side, I think this afternoon, because we are now entering or very close to entering the blackout period, right? Logan is apparently speaking later today, but I think this ISM services indicator PMI is going to be what the dollar bulls may be looking at to take the dollar the next leg higher, and then perhaps to see 130s, low 106s in the euro. I don't know where that's going to put the Dixie. Yeah, perhaps push dollar China a little bit higher again. And then we have the Bank of Canada. Nothing is expected. I think they are going to remain very neutral on this one. They did have a bit of a weaker GDP. They may talk about it. But if you want to keep the market guessing, I don't think that they would go dovish. If they would go dovish, then I reckon that the Canada is going to get another knock on the head. So those are the two things that I'll be watching today, that ISM services PMI and the Bank of Canada. And then, yeah, keeping an eye, but I think Blake is going to talk about it, keeping an eye on the mix.
okay.
Market is getting out of Mexican peso in some fashion. It even looks a bit panicky at some stage, but not sure for how much longer this is going to last. So
Look how much weaker the RSI structure is in the loonie. Ryan, pay attention, and I am, because you were starting to really pay attention. You've ridden this market very well from 3160. You probably still have some longs on. And yesterday you said, keep an eye on it. Momentum is waning. The RSI is saying that the USD CAD rally is becoming weaker than the dollar rally, and it led the way. So that's a little bit of a shift, don't you think?
Yeah, there's two forces at play. What we're seeing in this part of the rally is obviously stronger oil,
Right.
so that might be a bit of an anchor on the ankle. But yeah, I think you're right. You can see, what we saw early August, late July was pretty one-way traffic. Then it started pausing around 135, and it's huffed and puffed up to these highs. Still can't get and hold above that 136.50. Obviously, Bank of Canada in a few hours could be a different story. It could be at 135. Okay. It could be at 137, 138.
Okay, don't play roulette, traders. All right, Ryan's filling you in right now. It's pretty binary, according to Ryan, what's going to happen with BLC. So
yeah, but then we come back after, don't we? We see what they say, what they've done, what the market does, and then you decide what it's going to do from that point.
You don't predict the reaction and trade that prediction. You react to the reaction with your levels afterwards. That's what I learned from Ryan. So
I learned that from you.
Oh, really? Okay. Well, I don't
know.
Back to you. I don't know who I copied, but anyway, I'm glad it's getting around. So, that covers a lot of the currencies across the board. We're getting a little bit of a give back in crude, but not much. I mean,
well, that's really the other factor I think we need to start thinking about. The dollar Canadian, Dale. Good morning, and is how is this move in crude going to affect the Canadian currency? And I know we have the BOC today, but I think one of the things holding back the dollar Canadian has been the strength in crude. And if crude continues to rally, which I think it will on this breakout, it's going to be, the dollar CAD's going to be pulled in a couple of different ways. I mean, you have this dollar, you have this dollar breakout, but then again, you have this crude breakout. And with the crude breakout, it's probably going to bring in some risk aversion as it really, puts a lot of pressure on the Fed and other central banks to stop hiking rates in an environment where inflation's still going to continue to be an issue. So
talking about volatility, there's your VIX. I know last week you said the VIX on the DSI is about 9 single digits. It's not going to take much to start squeezing short vol sellers here. I wouldn't be short vol here, especially if it turns out to be correct that this is a failing rally, lower peak in S&Ps, which actually measures to about 4,100. If you take this and 1.618 of this from here is about 4,100. So
yeah,
be careful
and actually, so do you mind if I take the
No.
screen here?
Go ahead.
Kman kind of alluded to it earlier about the Mexican peso, and I want to talk a little bit about it. We'll come back to the Canadian here in a second, but I want to show you guys the dollar MEX and the big breakout that's happening right now. We came out of a descending wedge. We finally broke the 1745 level, and we're seeing a massive squeeze in the dollar Mexican peso. And as Kman mentioned, people are getting out of pesos, and it looks like, to me, at least the 200-day moving average is going to be tested, which is at 18. Eventually, channel resistance, which will take you up here around 1856. The other pair that's moving is the EURUMXN, and the EURUMXN is at really critical resistance today. You can see it. It's also at channel resistance, previous support, that is current resistance. It's right in the resistance zone. You can see we're just knocking our head up against it.
Nice divergence down there too.
Yeah, it's been divergent for a long time. I mean, if you look back at it here, I was positioned poorly in this, just kind of sitting in it, watching it. But you can see how it, this is divergent way back when, and we just kept knocking our head up against there. So it, struggles to break. But we are now up against channel resistance. You can see how this has finally intersected with price, the channel, and with the US dollar Mexican peso breaking higher. You can see that is now a big risk. Now, on top of that, going back to what you were just saying, Dale, with volatility coming off of support, and we've got the S&P that's trading really at, my opinion would be support here. You can see it. We have it on the bias chart as well. You can, from yesterday, or S&P support of 4480. We're trading right to it, or trade right down to it. If that starts to break, that's going to open up some more risk aversion, which would probably, spur some further downside in the Mexican peso. So you can see how it's all kind of connected here. And then going back to crude, I do think that crude is going to play a negative role in risk. Crude rallying is not a good thing, because it's not the reason why crude's rallying is because of cuts. It's not rallying because the economy globally is so robust that crude's, the demand is coming out, coming through the market. It's really just more cuts from Russia, cuts from from the Middle East and OPEC, and so you're seeing that feed into price. And as price continues to go higher, that's going to really put a strain, like I said, on the economy. So just a couple of things
exactly
to keep.
What I said this morning on the Flow Show. You don't mind cuts if there's a lot of demand, but if the demand's dropping, that's a different situation, isn't it?
Exactly. And so that right now, technically, that points to $96 in crude. I mean, that's what the target would allude to. But like I've said, and we've talked about here the last week, crude oil is at that inflection point where it becomes not a risk on instrument. It's an instrument as it rallies that's going to put pressure on all central banks to keep rates higher for longer. And when we're going into next week, We have the ECB next week. They're coming up obviously ahead of the Fed. You know, there's a lot of talk out there that the ECB could still, you know, raise rates and continue to raise rates. You know, a lot of people are kind of on the fence about that. But, you know, it's tough for central banks to stop raising rates or to keep rates unchanged if you have inflation pressures continuing to be heightened. So, you know, that'll be a conversation for next week, which we
plus
definitely will.
Europe has weaker growth than us too. So to keep tightening with weaker growth is also a problem for the economy.
Stagflationary, right? I mean, it is. And so, yeah, of course, that is definitely an issue. Well, let's talk a little bit about the dollar and what we expect here. You know, we mentioned, and I know Ryan and Kman, you talked a lot about the dollar Canadian because it's on your radar. I think the dollar CAD, you know, up against, we have a big resistance zone, and you can see the spike high back here from April. We basically have been testing it, channel resistance, testing it. You can see the support comes in right here at 135.65. I think the dollar Canadian is pretty well, you know, I would say it's pretty well identified for the range where we need to break out to cascade us higher, you know, for price, because you can see we're going to be running right into channel resistance on a breakout higher above 137. A break below 135.70 is probably going to expose some downside back to the 200-day moving average, which you can see. You know, I can move this out over here. Let's get rid of this. You can see the 200-day moving average right here. So I think we have a pretty clear indication of which direction, you know, to go on a breakout. I've been a little skeptical about the dollar Canadian up here. A lot of divergence as we're making new highs. You can see new high in price, relative strength is divergent. So I'm skeptical, but I'm not a dollar bear. I'm a dollar bull. So I'm a little skeptical trying to chase dollar Canadian up here. Ryan, I know you talked a little bit about it, but you know, the audience has grown since you were speaking a little earlier. What are your thoughts on the dollar Canadian with the Bank of Canada today?
Yeah, it's been saying it could be an important meeting, not just for what Canada does, but for how other central banks or how the market view other central banks going into the latter part of this year. You know, we've seen Canada, inflation's jumped above target, the core's still above target, growth has slowed, jobs has been doing okay, sort of along the same lines as the US. So this will be a good indication. What's the Bank of Canada going to do? They're going to speak about inflation, or they're going to speak about growth, and what's going to get them moving again? Will it be inflation turning them more hawkish, putting another hike on the table, or are they going to let it slide? And I think that's important, obviously, for what the Canadian dollar does today. But I think it's going to be important for how the market sees central banks as a whole approaching the year end.
All right. Very good. Kman, do you have any opinions on the Bank of Canada today that are different than what Ryan's just said?
No, I think they are going to try to be neutral, and I say the risk is that they go dovish. And then the Canadian dollar will likely get another little knock on the head. If you look at how it's holding, now when was it when we had that little move back down to 136 and then started to move higher again? Is it yesterday or the day before?
Maybe like the day before.
Yeah, I think
that was post GDP numbers on Friday, right?
Yeah, that's I think the market is still in the mood for not buying too many Canadian dollars. So I don't know, is a hawkish one the risk trade? Yeah, perhaps. But I'm pretty neutral on it, to be honest. And you were showing that zone. I've been showing that resistance zone as well. There was one in the 135s. Now we are trading in that zone in the 136s. It's really your gateway end could become a little bit of your neutral zone for a while. So pretty open on what they are going to say. But then to me, I think the US the services ISM will be PMI, sorry, will be perhaps even a bigger driver.
Yeah, so let's talk a little bit about the ISM. Why do you Well, actually, I know why, but I'm going to ask you to explain why you think that the dollar, why this is going to be important data for the dollar today.
Well, it's the most important. We are going into the blackout period for the Fed, right?
Yeah.
And we had those numbers. We had the move in the dollar, and I think we were looking at those levels in the low 107s as well, as I've highlighted. And here we are now waiting to see. And I think the early start of September traders or money managers are waiting to see whether it's going to be supportive, because we saw a little bit of divergence between the manufacturing PMIs in the US and Europe. And I think especially for the euro dollar is going to be an important one this afternoon, or a bit later in your morning for you in about an hour and a half. If we get a good print there, then I think your dollar is going to make probably a next leg higher if we get a good one. And the opposite may be just as valid, because I reckon some people are a bit long dollars there.
And you remember that the story is still U.S. exceptionalism, right?
Yeah, absolutely. And it's still very low.
No, cleanest dirty shirt. I don't know if that's exceptionalism.
Well, that's the thing, right? You look around and you're like, well, U.S. economic data, we're going to be looking at the ISM today, and I mean, let me just pull it up here on the calendar just so you guys can see it. The market's still looking for a 50 print, above 50. It's still an expansion, for services.
Yeah.
So it's pretty important, right, Kman? Because if we're still above 50, if that number's still above 50, it's still, you can call it the Goldilocks number, whatever you want. I mean, the market's going to like it.
Yeah, I think so, especially against what how the European data are looking right now.
Yeah, that's true. Hey, look, we have about 4 minutes before Dale comes on with Joseph Wang, and I love having Joseph here. He's so great, such great knowledge to have. So I don't want to take away from any of his time, but let's really quick go around the horn. And by the way, I don't know if Steve is here. Steve, are you here today? Not sure if he's tuned in or not. So it's hit or miss with Steve sometimes, but if he isn't here, that's fine. Ryan, really quick, what's the setup you're looking at today aside from the dollar Canadian, or is there anything other than the dollar Canadian?
I'm going to keep an eye on euro dollar at this 107. I've been eyeing it previously and I didn't do anything yesterday, so I'm going to keep an eye on another test on that euro dollar into 107. If that holds again, could give us a half decent support area bottom to play with.
And just so everyone can see here, the 107 level is the 127%, 107.10, excuse me, is 127% extension of the bounce that we had. That held pretty well yesterday, but we're still in a bearish breakdown, situation. So it's going to be really interesting to watch this euro and how it trades the rest of the week. So you're looking at 107. What happens if that breaks to you?
If that breaks, then we could be on for a move to that magical 105, and then all being well, I'll have the Hoover out.
All right. You're going to bring out the Hoover. That is a vacuum.
Go into your 102 dream buy zone, Mr. Morrow.
Yeah, I'm hoping for a move down to 102, and then I'll be all over it. Kman, what do you
61.8 back, Blake?
Yeah, I guess it would be right somewhere around there. Kman, what's on your radar aside from the dollar Canadian? Anything else?
Well, as I said, the euro dollar, I'm still a bit short. I think there's a fair chance we are going to see at least those low 106s if the numbers don't disappoint. And the other one is the Mexican peso, my friend. It's been a bit of a panicky move over the past 24 hours. Let's say call it that way. I'm less interested in the dollar MEX, but I think the euro MEX around 19 is going to be very, very firmly on my radar, because the fundamentals behind the MEX have not really changed. It's all a bit of a Banxico move on that currency hedge. People getting a bit scared, speculators getting out, and now people trying to take that excuse of the US Mexican investment or trade frictions to sell some more Mexican peso, but I'm really keeping a very close eye on that EURMX around 19. If ever we get there, I'm probably going to give it a go to the other side again.
I heard they're taking the worms out of their tequila.
Well, the thing about that Mex, and it's really moved ever since they removed that. They're starting to reduce their hedges from, you know, post-COVID lockdown panic time. So it's interesting. I still like the dollar Mex. I like it to the long side. And that EUROMX, I think you're right. 19 is going to be kind of do or die for that pair for sure. Hey, we have the trade bounce should be coming out. The US and Canadian trade bounce. I don't know if it's out just yet.
It's out.
Come out. Canada week.
US a bit better.
A little bit better than expected. Not a lot of
actually no.
Here.
Sorry, Canada also a little bit better, but activity data not very good.
All right. Well, we'll be probably waiting for the Bank of Canada today. That's going to be probably the bigger mover. I'm gonna leave you guys with, you know, as far as I'm concerned, the dollar Mexican peso is in breakout territory, but we got to see how if it can hold above 17.40-45. If it can hold that 17.44, 17.45 level on a closing basis, that just gives me more argument to be, you know, short some pesos and look for a squeeze out to the 200 DMA up here around 18, which is, you know, it's percentage wise, that's still up, you know, good 3% away, which is a big move for the currency market. So with that being said, Dale, I'm going to pass it over to you so you can have a great interview with Joseph Wang, Fed guy. So Dale.
If Ryan, it's going to be great, it's going to be because of him.
What's that?
If it's going to be great, it's going to be because of Joseph.
That's right. That's right. All right. So everybody make sure you stick around. Probably one of the best interviews coming up.
Yeah. So Joseph, people are calling you the Fed Whisperer in here. Welcome back to F.A.C.E.
Hey, Dale. Thanks so much for having me. It's a pleasure to be here.
So do you like that moniker, the Fed Whisperer?
I think that's very generous. I think it's taken already. I'm happy with Fed guy.
Stick with your handle. So I wanted to talk to you today about, you know, the last thing that you were writing about, because what's happening with the banks is very important in some of my narratives. So your last article is talking about dollar deleveraging. And you made the point, this is on your free letter, that foreign banks are actually under more duress than the regionals. And the regional, it's hard to imagine when I look at the regional chart, the KRE, that these banks are under more pressure than the regionals. Is it because they have the duration book that the regionals had? They're underwater and out of long bond positions from the COVID days when rates were so low. The last time they were that low was the first Civil War in the US.
So yeah, so rates have gone up a lot. I think another point that's worth mentioning is just the profitability of how these banks work going forward. So as we all know, banks have short-dated liabilities and longer-dated assets, right? So when rates go up, well, that could, in some cases, squeeze their net interest margins because their short-dated liabilities reset higher than their longer-dated assets. Now, that's the theory, but in practice, that really impacts banks very differently. If you are Bank of America or JP Morgan, for example, I mean, the Fed could hike rates 5%, and you're basically still offering your depositors something close to zero, and your depositors take it. You offer great services, you're too big to fail, and people just kind of accept lower deposit rates. So it doesn't really affect you that much. When you go down the ladder to the regional banks, you know, you see them trying to pay up a little bit more on their deposits. So that's squeezing their net interest margins, so making them less profitable. But now when you move out abroad, when you're looking at foreign banks, well, that's a completely different ballgame, because foreign banks, they don't really have a lot of retail depositors. If you're like in, if you're in Thailand or if you're in Japan, there are people with dollar deposits. They're just not mom and pops. They tend to be corporations and institutional investors that are active in international trade or finance or something like that. So these guys, they want market rates. So when you go out of the country, and the way that the dollar works, it's a global currency. So you have a lot of foreign banks with big dollar loan books making dollar loans to international corporations. So those guys, they don't have retail deposits. So when the Fed hikes rates, their funding costs really do go up to around 5%. And that's really squeezing their margins. And you can actually see them delevering. So their dollar loan book is shrinking at the fastest pace since the 2008 great financial crises. In the US, we see that banks have basically, slowed down their loan growth on aggregate to very, very, very low levels, but they haven't actually contracted. But you see outright contraction when you look outside of the country. And that's going to squeeze a lot of these foreign companies. And it's going to be it's going to be a headwind for international trade because let's say you're a company in Thailand or India or something like that, and you need to participate in international trade, you need dollars to do that. Dollars are basically the currency of trade. They facilitate international commerce and so forth, and now it's less available. So I think that's a headwind, and probably why you see there's this global manufacturing slump. If you look at the PMI data, I think part of it is because a lot of companies, they can't get the financing that they need.
Okay, so I mean, it's not only regionals. Here's Goldman. So
no, I want to be clear though. This is the dollar banking business of foreign banks. Okay, it's just a small part of their overall business. So it doesn't mean that they're not doing well or anything. It's just that they're one aspect of their business
is under pressure. Okay.
Yes, that's right.
All right. Okay. So obviously not just the rates, but what has gone hand in hand with the rates has been a relentless move in the dollar to the upside, Joseph.
I was listening to you guys' discussion.
Look at that. I mean, since the bottom, we've had very, very few pullbacks. To me, this is pretty relentless. I know a lot of people are bearish a dollar.
I'm super bullish, though. Super, super bullish.
I figured you would like this chart today.
It's been a painful topic for a few months, but finally it looks like it's perking up.
Well, this whole process took time. Everything takes longer than you think it's going to take, doesn't it?
So the way that I think about this, I think that last year, right? So we had significant dollar strength since the Fed was hiking so much more aggressive than everyone else, and that I think that policy divergence made the dollar shine. I think we're about to see the return of that, but in another way, in the sense that the Fed is going to be, so on the way up, the Fed hiked much more than everyone else. On the way down, the Fed is going to be much slower to cut than everyone else. The reason simply has to do with how policy works internationally. So in the US, there's a few things, moving parts. So in the US, Fed hiked, probably going to hike one more time. The economy still is doing
this month.
It's probably going to be December, I think.
Okay.
So even though the Fed hiked aggressively, the US economy is still doing really well. We're still growing above trend. And we have been for the past 2 quarters. And it looks like this quarter, we are going to do even better. We have strong fiscal deficits that are supportive of the economy, but we also have an economy that's just not as interest rate sensitive. I mean, think about households. We all have 30-year mortgages. That's totally not the case for many other countries. If you look at Canada, for example, those guys, they're under a lot of pressure. Why? I mean, their mortgages reset within 5 years.
Doubled.
So a lot of people. Yeah. And you can actually see the political pressure being built. So Steve Sardinsky has a really good Twitter thread where he's showing that the premiers of a few provinces in Canada are writing letters to Tiff Macklem, the governor of Bank of Canada, basically begging him to not hike rates. So they're basically maxed out. It doesn't seem like they're going to.
Today,
So I don't think anyone thinks they're going to hike anymore, right? Their GDP numbers last time were negative, and they have political pressure, so it's probably not going to happen. So they're probably done, and they're probably going to have to think about cutting in the coming months. And I think you can make the same case for the UK, and probably to the Eurozone. The Eurozone is a bit more complicated because it's more of a political aspect. But I think that if you look at data for some of the big Eurozone countries, it's very clear that countries like Germany are not doing well. So they really can't handle rates the same way the US can because their economies are more sensitive to it. So they're going to have to stop and they're going to have to cut first. So as that happens, I think the interest rate differential is going to widen between the US and others, and we'll see the replay of what happened last year with the dollar continuing to strengthen.
Do you have levels where you would be looking for maybe your
So
own
I'm going to have
curve?
to, I'm going to have to definitely defer to the guys here. I mean, you guys do the technical stuff. So I
but
was
you
thinking,
think there's duration. But what you're saying is this is not going to be a flash in the pan move from mid-July to now, but this is going to have legs at least in time.
Yeah,
correct?
I think it's going to persist for the next few months.
Okay.
So again, things change, right? But from what now it seems like, just looking at how our respective economies are doing and how monetary policy works, I think it's going to play out for a few months at least.
Okay. All right. So another article called "Adrift at Sea." Is that you and me, or the U.S. or the Fed? Who needs a lifeboat?
So, this is talking about interest rates. So I've been very, very bearish on bonds. So I've been thinking interest rates would be structurally higher. Been writing about this for some time, and I think we're seeing this happen. So there's two things driving this. The one that I've been focusing on in the past really has been supply. I mean, basic demand, right? Supply and demand. Yeah. Just tremendous amounts of supply. And I think the market is catching on. We had an article in, a generic mainstream publication, the Washington Post, talking about fiscal deficits. Now that's one thing, and that's definitely an upward pressure for interest rates. But the second thing that I think it's a little bit new is that for the guys who are more fundamentally minded, guys who care about things like, neutral rate and inflation expectations, and I'm not even sure if there's that many people who really look at the world that way, those guys are changing their mind as well. And there's a couple of things pushing them to change their mind.
Are those the bond vigilantes from the 80s that their kids are carrying the torch?
I think there's old school macro guys from another generation. So if you look at interest rates,
like me.
So,
old school
I don't know. Huh? I don't know how you look at things.
Okay. Anyway, I know.
So
I'm in the tar pit.
So those guys, they think about rates as, neutral plus inflation expectations as longer dated rates. Now, both of those things, I think, are being adjusted higher in market pricing. If you think about the neutral rate, Fed traditionally thinks of it as 2.5%, but it's very obvious that Fed raised rates 5% and the economy didn't really slow. So a lot of people are beginning to think that maybe the neutral rate is higher. If the neutral rate is higher, then interest rates have to be higher structurally going forward, and that feeds out into the 10-year. Okay. The next thing, of course, is inflation expectations. Now, there's a lot of noise, some really important people thinking that maybe we should raise the inflation target. I don't know if that's going to happen, but I know if that it happens, it's going to begin with a lot of important political people making a lot of noise, and that's happening now. So if you're someone who's buying a 30-year treasury bond, you have to think to yourself a little bit, maybe within 30 years, and 30 years is a long time, maybe the Fed adjusts their inflation target, maybe to 3%, 2 to 3%. Now I have to price that in a little bit, right? Because, if I get this wrong, it's a lot of money. It's 30 years, a lot of duration there. So I think those things are happening as well, and that's going to put upward pressure on interest rates.
On more of the long end, and that would be a segue into your steepening stance. That
I think the Fed is steepening.
Okay, because the long end is where they came out with most of the new supply a month ago, right?
Tons of factors, those two things that you just mentioned and we just discussed. But the Fed, I think, is trying to steepen the curve as well. How are they doing this? I think they're doing this because they're talking about not letting QT continue even when they start cutting rates next year. Now, usually you would expect the Fed to, not if they're cutting rates, you don't want to do QT, right? You want your balance sheet and your overnight interest rate to move in the same direction. You don't want to press on the gas and the brakes at the same time. That's traditional Fed thinking. But they're changing their mind now. They're saying that, maybe these we can do these two things at the same time. And so next year, when the Fed is going to cut rates a little bit because inflation has come down, they're talking about letting their balance sheet continue to shrink. Now, cutting rates is, of course, making the shorter term rates lower, and letting QT continue is putting upward pressure on longer dated interest rates, right? So that's a steepening posture. And so I think that's what the Fed wants.
So what will bears hang their hat on, since they've been pointing towards an inverted curve for a few years now as being pretty reliable, huh?
Yeah, well, the bears who have been bearish on the U.S. economy have been not just wrong, but ridiculously wrong, because the U.S. economy is not just going above trend, it's accelerating. Okay, so accelerating to the upside is the complete opposite of going into a recession. So I think they're probably going to be wrong on this again. So I don't think the inverted yield curve tells you anything. Tells you a lot. The world in the future is not going to work the same way as the world did in the past.
Any view on equities? Looks like there might be a little failing rally here. S&Ps.
I think the highs are in for the year. I don't think we're going to crash, but I think that as yields go higher, I think that's going to put a cap on equities. You see that? So I want to be clear. So yesterday, price action was really confusing to me. We had markedly higher yields, the 10-year up 9 basis points. We had the dollar strengthen, but equities seemed really resilient. So there could be some flows related to OPEX. This month is a major September OPEX. Maybe that, I'm not too sure. But the equity market does seem pretty resilient to me. I don't think we're going to make new all-time highs or even make new annual highs, but I don't think we're going to crash. There just seems to me a lot of surprising strength there.
Oh yeah, I mean, look at all the headwinds it's faced, Joseph. And I know I've fought the S&Ps quite a few times this year, but I mean, you look at the 10-year, we're back at the October highs. Okay.
Yeah.
You have currency situations like the yen. We're almost back at intervention levels at October. You have the yuan at those levels. That's where the S&Ps bottomed in October. So you've had all these markets retraced to what was a critical low in the S&Ps, and the S&Ps have fought these headwinds all the way up. It's amazing to me.
It's amazing to me as well. I would not have expected this, but it just seems like there's a lot of strength there.
Okay, well, we'll see. Most people are in the correction camp. I could see their reason, maybe around 41, 4,200, a little bit more of a pullback in your view.
Yeah, I think that's the exact phrasing I would think, a pullback, but not a crash. And
okay.
Yeah.
Does this make the Fed's job a little more difficult? I think on Labor Day, gas prices were the highest that they were in quite some time, because we never really, I don't know, they could blame it on refineries or whatever. We never got huge price reductions on the break in crude. A lot of people are calling this a breakout, that we could be headed for 95 or $100 crude. What does that do to the Fed's formula here?
It makes the Fed's job a bit harder, right? So, I mean, we could see inflation reaccelerate. Now, the Fed tends to look at core inflation, which doesn't include these energy prices, but they'll have to pay attention to it if it's too high. And I think you raise a really good point about oil. So when I look at these markets now, I think we have to take more and more into consideration global politics, because obviously there's an economic war going on, right? So when inflation is high, you had the Biden administration basically emptying out the SPR to try to get oil prices lower, right? That's a big political actor trying to push oil prices low. now you had the OPEC, especially the Saudis, fight back, right? They are restricting output, them and the Russians, and trying to get oil prices up. So there's an economic war going on, and it's not just in these oil things as well. We have to look at the big global economic relationship with the U.S. and China. Very obviously,
chips.
The U.S. is trying very hard to kind of poke the dragon, and so the dragon actually also has options to fight back as well.
And they haven't yet, except in language. What do you think they're going to do?
A very obvious thing to do, of course, is their huge holdings of treasury securities, right? They can make interest rates go up a lot by just kind of selling them a bit. So if this conflict is long lasting, if you think about it from the Chinese perspective, obviously I can't be holding a lot of US debt or even US dollars, because what happened to the Russians could happen to me. That's a huge vulnerability. So structurally speaking, they have to get out of this trap somehow. And so for them, I think the most obvious tool that they have to fight in this economic war is their influence on US interest rates through this tremendous treasury holdings. Now,
they're not holding as much.
I would be careful. I would be careful about interpreting that data, because that data is going to be based on market values. And as we all know, there was a big bear market in bonds last year, right? So that's going to make the prices of bonds go down. So I would be careful about that. So it's hard to know what actually the Chinese hold. It's a state secret for them.
It's still a bear market.
We could paste together some stuff indirectly, but it's a state secret as to what they hold in their foreign reserves. But hey, this is a tool that they have that they can use against the US in this economic war that is happening very obviously, right? You got sanctions, you got all these export restrictions. And now the Chinese, I saw a headline today that they're telling their government agents to not use iPhones, just in the same way the US doesn't like anyone using Huawei. So this is happening, and their obvious tool to me, of course, is interest rates.
Short Apple. Anyway, I wanted to wrap it with, you said we were in a bear market. This rally or stabilization in the bonds, and you know what? I have to thank you, Joseph, because there are a few times I was thinking about bottom picking it for more of a bear market rally, and you would shake your head at me. No. Okay.
So I think we get to 4.5 on the 10-year by the end of the year. I think we can see 4.5. But listen, if you want rates, so this is what I like. So I think agency MBS are better than treasuries because one, they're yielding more. Secondly, I think that the spreads between agencies, MBS, and treasury are probably going to tighten, because since mortgage rates went up so much, we have a lot of people who there's not a lot less supply, right? People are not getting mortgages at the same rate they used to. The supply is going to supply, and I think people are still betting that soon we're going to have rate cuts and there's going to be this big wave of refinancing. And so that's being priced into the prepayments and mortgages, but I'm not sure that's going to happen. We might stay higher for longer in that sense. So some of the mortgage REITs, I think, are offering maybe 10 to 15% yield. And if the curve does steepen, so the Fed cuts short rates and maintains QT, I think that it'll play out well for those businesses.
Okay, I just wanted to see if you could answer this question. I don't know if I asked you last time, but why do people have more confidence in junk? Look at that chart, and less in corporates and TLT. So why is HYG, why does it have such a better looking structure and is held together better than sovereigns or corporate grade A, investment grade corporates?
My sense is that the junk stuff is shorter duration, so it's not as impacted by interest rates. Okay. That's probably why.
People have a feeling they have a higher percentage of getting paid by issuers of junk than our own government.
Well, to be clear, credit is doing well. Spreads are within historical ranges. Defaults are low. they're rising, but they're still around historical ranges. So there doesn't seem to be any credit problems in U.S. businesses at this moment.
Okay, I wanted to show your website,
Great.
so that people know where to go. So it's Joseph Wang. Let me just go to my profile, and we'll get it there. Okay. Okay. So Joseph, you also have a course. All right. So
yeah. So my website is fedguy.com, and I also I have weekly blog posts about what I think is happening in the markets, what's interesting from the perspective of a financial system. I have a bank, Central Banking 101, bestseller on Amazon, talking about how the financial system works. And I also have online courses called at my website, centralbanking101.com, where I talk about more teach about different macro asset classes. So if you're interested in having just more of a foundational view on just global macro, check it out. Some of the courses are free.
Okay. And, to most people, what central bankers do is voodoo. So Joseph brings it out into the light so you can have an understanding as a layman. So like always, Joseph, thank you very much for, sharing your views with us and edifying the F.A.C.E community. I appreciate it and wish you good fortune going forward.
Thanks, Coach. Happy trading, everyone.
All right, Joseph Wang, everyone, follow him at FedGuy12. Adios, and you could join the team in about 15 minutes on the Morning Edge. Thank you again, Joseph. Adios, everyone. See you tomorrow. Don't just count your pips, count your blessings.